Hello, I'm Alex Davies, founder of Wealth Club, and today we're talking about investing in AIM shares for inheritance tax purposes. AIM, the alternative investment market, is home to hundreds of companies, typically younger, growth-orientated businesses. As well as offering the prospect of investment returns, many AIM stocks are also eligible to be free of inheritance tax after 2 years. With IHT receipts topping £5 billion last year, it's no surprise that managed AIM portfolios have been rising in popularity with wealthy investors. And since August 2013, you've been able to hold them in your ISA, giving investors 3 tax benefits in one. But many investors are still suspicious of AIM, and the occasional bad news stories give people reasons to worry. So is it a smart place to put your money if you're concerned about inheritance tax? Today I'm joined by 3 guests who all manage AIM IHT portfolios. Chris Hutchinson of Unicorn, Justin Waine of Puma, and Stephen English of Blankstone Sington. First, Chris, can you tell me, why should I invest in AIM?
We would always tell potential investors on AIM that they should not be doing it solely for tax reasons. We would also recommend a portfolio-based approach to mitigate any kind of risk. And finally, I think one has to accept that it is a riskier, less highly regulated market. However, there are some really high quality businesses listed on AIM, and they're listed on AIM for very, very sound reasons. And I think it is important, therefore, to make the distinction between those businesses. Many of them are early stage, and clearly there is a risk that some of those will fail. But it's also possible, when constructing an IHT portfolio type approach, to select a dozen, 2 dozen, 3 dozen companies that really ought to do at least as well as companies listed on the main market, for very good reasons, because they happen to be profitable, cash generative businesses selling products and services that add a real and tangible benefit to their customers. So AIM has had a bit of a varied reputation over the years. It's almost certainly going to continue to be a bit more volatile in terms of its return profile, but I think there are plenty of good reasons to invest on AIM, as long as you're selective about the kinds of companies you're investing in.
And Stephen, have you got anything to add to that?
I think Chris is right in terms of you never let the tax tail wag the investment dog, and each portfolio does stand up in merit. The way I describe AIM, I think increasingly you're going to find tomorrow's winners rather than yesterday's winners. You look at FTSE 100, doesn't necessarily connote that it's full of strong companies. There's a lot of stale industries, old industries, a lot of cyclical industries, whereas a lot more vitality on AIM, and especially those that are raising growth capital. They are at the smaller end, they can grow quicker. That's where your multi-baggers are to be found, much more so than the main market.
And Justin, who's the sort of typical person who invests in the AIM market?
Well, the typical person is actually the older end of the age spectrum, so somewhere north of their 60s, who's starting to look at inheritance tax. Often there's someone that is in the sort of upper end of the mass affluent, lower end of the rich, so sort of a net worth of somewhere between $1 million and 5 million, the kind of level where it's really sort of complicated offshore tax planning isn't really worth doing, but where there's enough of an inheritance tax hit where they start willing to look at it. But it's also got to be someone who is experienced in terms of equity markets and the risks that they run. We've discussed a little bit about the risks on the AIM, and therefore if you are comfortable with investing in equity markets, the AIM market is just that. It's a collection of small cap companies that you can invest in. And particularly for ISA investors who have built up substantial ISA portfolios. So you've got people with 300,000, 400,000 in ISA, some people who've even got £1 million in an ISA. Often they're not aware that these will be subject to inheritance tax when it passes down to the next generation. And therefore the AIM really, if you want to keep that ISA wrapper, which is very, very, very valuable for income tax and capital gains tax purposes, the only real way to do that while mitigating inheritance tax is to use an AIM-based product.
And of the stocks you're choosing, would you actually invest in them if there wasn't inheritance tax relief? Is there a market for them other than because of the inheritance tax relief? Who else is buying these?
Oh, definitely. I mean, a lot of the companies that I buy are actually family-based businesses. So often they were companies that were listed for sometimes decades on the main market. And they came to the conclusion there wasn't really much point being on the main market because they weren't planning to raise much more money, but they still wanted to retain a quote. And they had done trust planning to move the company down through the generations. And they realized they could, by simply moving down to the AIM market, get the benefits of inheritance tax mitigation that our services aim to deliver to investors. And so often you're investing in a family-based business, very high quality business, high returns, high margins, that has delivered growth for decades and is likely to continue to do so going forward.
And why will a company, Chris, just list on AIM rather than, say, the main markets typically?
I think that is precisely the point. If it's a business that's qualifying for business property relief and the management team or founders retain a meaningful equity stake in their business and want to retain it post-listing, then AIM is a natural place because, of course, it all boils down for us to alignment of interest. If those founders or management teams own a big slug of their own business, they're likely to look after it in a very prudent way and try and avoid as much risk as possible whilst continuing to grow over the long term. And the tax reliefs available to those holders of the equity are very, very meaningful. And of course, whilst those laws and rules are in place, it makes AIM a very attractive place to consider listing for an established and profitable and sensible business.
Of course, there's also a lot of businesses that might list because the regulation is so much less, and of course that has its pitfalls as well, doesn't it?
That's absolutely true, and in the past, pre the financial crisis of 2007-8, you'd look at AIM and the constituents of AIM were largely junior oil and mining and resource stocks, and they were highly speculative. Today, I think it has matured significantly, and I would argue probably there's still a two-tier approach. In fact, there are probably three levels now on AIM. There's the mega cap AIM stocks, some of which are approaching 5 billion in market size. There are the very small early stage growth capital businesses, and then the ones we've been discussing, the established profitable cash generative dividend paying businesses where the management team and founders have retained a stake in their own business.
And Stephen, despite all this, it's still massively risky, isn't it? We've had Conviviality, we've had Patisserie, Valerie. How risky is investing on AIM?
It's risky, but any equity is riskier. I think it's like, well, the Japanese blowfish is risky unless you slice it up the right way, but it's a delicacy. It's delicious, apparently, if you do handle it correctly. And that's the same with any equity. You know, Tesco had a accounting fraud. It lost 70% of its value. And Carillion was a recent example. Just because you're on AIM, it might not be the most salubrious of areas, and there's quite a lot of noisy neighbours around, probably more so than the main market. But sift through that, and if you are very, very, very selective, and you need to have a very high filter or hurdle rate and reject probably 95% of the things on AIM, a lot of it is dross. But if you're selective, there's some terrific, terrific companies that are creating jobs for the UK, driving GDP, and they are solid businesses at the end of the day.
Follow up on that point. Once you've made the step to invest in equities, you're investing in equities where potentially there's a 40% head start from the tax break. So, you know, you say, well, there's a risk that you'll get caught by frauds or these kind of businesses, and they are probably more prevalent on the AIM, but they're not so much more prevalent on the AIM, particularly if you're careful, and I suggest you sift through carefully and you manage to spot at least most of those things that are coming in the direction of the portfolio, that you can have the opportunity to make very, very good returns.
At the same time, obviously, people who are investing in this, they're older. Again, is it too risky for them, or are you finding companies, on the face of it, it seems that you're going to lots of young companies? That's quite risky for someone who wants to perhaps preserve their capital. Is that a fair criticism? It
depends to be honest, it depends very much on what the next generation looks like. I mean, if the next generation, has a massive mortgage, a Ferrari on hock, and 5 kids in private school, then maybe a sort of more traditional capital preservation, business relief solution might be the way forward. But a lot of these portfolios, particularly these ISA portfolios, are just going to drop down through the generations. So if you do have a very bad market, and the AIM might underperform the main market in a significant downturn, but it should move, it should still deliver good returns as equities over time. they can just retain the portfolio and get the business property relief themselves.
And what sort of companies then are you looking at? What's your ideal company when you're looking to invest in something? Family owned?
Family owned we like. We're a bit more value based than some of our peers, so we tend to look for the stuff that's quite cheap. We like good quality companies. We look for companies with high returns on capital employed that beat their cost of capital. We like conservative balance sheets with plenty of net cash, and we like lots of free cash generation. And we like management or a family to have a good sized stake in the company. So as we discussed earlier, that we know that they've got the skin in the game.
Stephen, IHT, there's always the argument it's an IHT bubble, so all these stocks are propped up by the IHT demand. Is that a real issue?
It is, and again, there's different strata in the market. I've been very concerned, quite vocal about it at the upper echelons of AIM. Some of it no longer makes sense to me from a risk-reward point of view. No company is so good that you can't overpay for it. And I've got a contact in the city who's now getting approached by AIM companies who is looking to try and rebalance their shareholder register because the AIM IHT investors are too big a part of it. Now, you need a mixture of shareholders. You need some of the long-only institutions on there. You need IHT, but a bit like the Venetian tourists, too much of a good thing can be a bad thing. There's a crowding out effect what's gone on. So this has pushed up valuations, which is deterring the long-only investors from coming in, and it's making it very difficult now for certain AIM companies to raise capital because us as IHT AIM investors, we might have hundreds of individual clients and we can't really get a big lump sum together in short order, whereas the Fidelity, the BlackRocks of the world can. So there is definitely a problem, from my perspective anyway. That's why we are no longer holding most of those companies. We used to own them, but they've got too hot to handle for me now. So I'm looking at the lower end of the market cap spectrum.
What sort of market cap are you looking at typically?
My average market cap is 200 million, but by quantum, the bulk of them are 150 million or below. Not doing it for doing its sake, that's just where I'm seeing the last remnants of some genuine value.
And Chris, what do you...
I'd agree with a lot of what Stephen said. The top 10 companies listed on AIM are all above $1 billion in size now, and many of them are valued on most normal valuation metrics at historic highs and possibly at unsupportable levels. And I think that has, to a significant degree, been fueled by the weight of money coming into IHT strategies, which is why actually, in the end, not only do you have to be certain that you're investing in half-decent businesses, have that investment spread across a collection of those good businesses, but also be mindful of value at all times, because at some point that valuation of the large AIM-listed companies might end up popping a little bit, and it's very much predicated now on being priced for perfection with high supernormal growth rates, and once those growth rates start to decline, then those businesses could find themselves in a lot of trouble from a valuation perspective.
And what usually happens, so if you have a recession in this market, a market crash, what happens to AIM comparatively? The sort of stuff you're looking at, right? Let's take out all the...
Well, let's wind back to 2008 then, because AIM as an index 10 years ago ended 2008 with its value down over 68% in a 12-month period. Now, I would argue that in the 10 years since then, and some of the changes to the inheritance tax laws and where you can hold stocks, including in ISAs now, it has matured significantly. It has been de-risked to a large extent. But of course, like any other index, it's going to be subject to significant shifts in value if a recession or when the next recession comes along. I doubt actually that AIM will underperform main indices under current rules regime, because if you stop and think about it for a second, not only do the investors in IHT strategies have to be holding them for 2 years, but importantly, they have to be holding those stocks on death. So there's a real disincentive to sell them first once a market starts heading south. And I think that'll be really interesting the next time we see a sustained correction, because I've got a feeling that AIM might actually surprise people by being pretty resilient.
Justin, do you have any views on that?
I've got sort of on both those 2 points that you made. I've got a slightly different view. I agree with the fact that the upper end of the market is on extended valuations. I slightly disagree as to the reason. I think a lot of it is more about the premium that is being placed on growth stocks globally, but also in the UK as a factor of Brexit, and people don't want to own anything that's sort of too UK-centric, too consumer-centric. So I think that's driven up the valuations, and then the BPR issue, the BPR money coming in just adds on top of that. And that sort of goes to, again, to the point about what happens when there's a significant decline. And there's the good news and there's the bad news. The good news is that I think a large number of those companies will see very significant devaluations. I frankly think they'll see that even irrespective of a large market decline over time. So that will have an impact, and because they're such large constituents of the index, that will have the effect of knocking down the index. The bad news is with, and that's good news if you don't own them. The bad news is the fact that the reality of it is that small caps tend to get bunched in as a group and hit as one in market downturns, which is why, if you look at small cap indices generally, they drop very strongly in 2008 relative to larger cap indexes. So, I mean, that's always the problem, is you're in a liquid market. It doesn't take an awful lot to actually start dropping these share prices. The positive news on the other side, however, is that a lot of these shares that are a bit more UK focused are actually on single-digit earnings multiples. So that doesn't imply to me that there's a blanket bubble across the AIM, because you can find plenty of companies on low valuations.
How do you decide which company to invest in? What do you look at?
Well, as I said, the first thing we do is a spreadsheet, and we actually crunch through the numbers, and we look at what the margins are like, what the returns are like. We look to make sure the business generates some cash flow, and we try and understand what the business does.
Meet the management?
We do occasionally. I mean, a lot of my competitors, they're big fans of me and the management. They'll tell you how many hundreds of meetings they do a year. I spent a lot of time meeting management, and I eventually gave up on the grounds I just couldn't tell when they were lying, usually because a lot of the time they didn't know themselves. So I take the view, I meet companies to understand how its economic model works, but after that I really stick to the numbers, and it's a case of working through the financials and sort of relating that to where the cash flows will go over time. Is how I sort of decide on my investments and how certain those cash flows are going to be.
Chris, you agree with that? Do you meet the management?
Yes, we do always meet the management teams of the businesses we invest in. We're also we're the manager of a very large AIM-focused venture capital trust as well. So naturally, that's the starting point for our investment in some of these early stage AIM-quoted companies. We get to know them quite well under that framework over a period of time. And once we're confident that they're delivering to expectations, that they're growing as we'd expected, then they become perfect candidates for inclusion in our AIM IHT portfolio strategies. That works very well for us, and clearly in a venture capital trust, I mean, it is venture capital and there's a higher attrition rate, but at least we've had the opportunity to really test our investment thesis with those businesses before putting them into the IHT strategy.
I think there's a nuance that we haven't touched on as yet. It's coming back to the shareholder register and what it looks like, and there's a proliferation of AIM IHT providers, some coming to the party relatively late, and it's important for investors to really look under the bonnet of each and every provider. There's a lot of overlap amongst certain providers in terms of the holdings that they within their portfolio, but moreover, another risk that we haven't quite touched on at the moment is the change of tax risk. Use an awful expression, but there's certain AIM stocks that are pregnant with BPR risk. Should the rules change, there's a big part of that shareholder register that has to come off that register, or will, pretty quickly, and the valuation to my mind is so exalted, you'll have to see a very, very, very sharp derating before the long onlys in London will start to take those shares off their hands. So if you look at the shareholder register, interrogate it a little bit more, you can start to almost preempt where the risk or pinch points potentially are.
Oh, of course, all of you guys earn money out of managing other people's money. Couldn't I just do it myself, Chris?
You could. I think it would be, you'd either be very lucky or really knowledgeable to be able to devote sufficient time to do it properly. And I think that's the point, is that a lot of these people may well have built up significant wealth, but they're professionals, they're pursuing, they're at the top of their careers, and they're busy people generally, and they don't really necessarily have the time or the inclination to do it themselves. Of course, there are plenty of people who actually enjoy trying to pick out good AIM companies and invest in them directly. And there's nothing wrong with that. My approach is quite simple. We're not in this to maximise the amount of assets that we've got in these strategies, and we would certainly stop marketing if we felt the flows into the strategies were getting unsustainable. And I think that's the point, is that it has to be client-led. They have to understand that they're putting their money at risk to an extent, that they're doing it for a very specific reason, and actually finding a professional provider to manage that on their behalf is a pretty sensible thing to do for 95% plus of the people who are interested in this area.
I mean, the other part of it is it's not just about the investment management. I mean, you know, there are private investors who have terrible investment track records, and there's some private investors who have amazing investment track records. The other part of it is the business property relief angle, which is that, you know, business property relief changes for companies. So you can go out there, you can build a portfolio of 20 BPR qualifying stocks. There are websites out there that will provide you with a list of what they think qualifies as BPR. I wouldn't necessarily say they're 100% accurate, but you can do that and you can build that portfolio. And that sounds very attractive as a private investor. And then you say to them, and then you can get up at 7 o'clock every morning from now until the day you die and make sure that the BPR status hasn't changed on that particular company and all the companies in the portfolio. At which point, you know, they suddenly think, you know, what we charge is considerably less unpleasant.
That's a very good point. And there's one other point I'd make, is that actually you need to be a regular and significant market participant in order to be able to access liquidity. We deal with 20 plus brokers in the small cap space. They know exactly what we expect, what we're looking for, and they're for the average investor, I would imagine trying to do it DIY process, you'd go onto your electronic platform provider and you put an order in for £5,000 worth of stock, and the spread would probably be quite wide. The cost might turn out to be a lot higher, and ultimately you probably won't even be able to get the stock that you're looking for trying to do that yourself. I mean, obviously, if you're looking at the largest, most liquid ones on AIM, then it's possible, but as we've already discussed, I think all three of us agree that the valuations there make it less attractive.
You end up with a portfolio on 30 times earnings, and good luck with that.
And the likelihood, I think, even if you're the best investor, probably the people who inherit your money aren't going to be, so they probably don't want some messy AIM portfolio that they have to sort out.
Absolutely. And the other thing to mention, which hasn't been really touched on, is that for someone in that situation, clearly they've been successful, they've built up a lot of wealth, and when it becomes the appropriate time for them to consider mitigating any inheritance tax, I suspect that the vast majority of those people are parking that money forever. They're not expecting to get access to it again. They're simply doing it to pass as much of their hard-earned wealth onto the next generation as possible.
So we talk about all the inheritance tax benefits, and some people think, well, you shouldn't get them. Why is it so important to the AIM market, inheritance tax, Stephen?
We are attractive investors to have on the shareholder register. We provide liquidity in small size. What that does, it helps lower the cost of capital for these companies. A lower cost of capital allows them to grow quicker. If they're raising money, predominantly with other investors, long-only institutions in London, although we do partake in some placings and very, very, very selectively, I reject 99% of IPOs, but it has been a key value added kicker. It's one of the last places where few of my peers can tread. We do take part in IPOs, and that is providing growth capital that are to companies that are long on prospects but short on capital. So demand isn't a problem, they just don't have the capital to meet that demand. And SMEs are grist to the mill for the UK economy. They do create a disproportionate amount of new jobs, and the Exchequer, HMRC, do value that, and they do see the benefit of this what appears to be a very generous tax kicker. They do appreciate the benefits. Yeah,
I mean, I think it's interesting if we go back to the actual history of where BPR comes from. It was introduced in the 1970s by a Labour government, and it wasn't introduced to give people an inheritance tax break. It was actually introduced to preserve employment. So what you were having was private companies which were family owned having to sell themselves to pay an inheritance tax bill. And as a result of that, workers were losing their jobs. So that's why the legislation was passed. And I think it still applies today. As we went to the previous comments, having this investment, having this money in the AIM market does lead to job creation in smaller based businesses. It does give them long-term capital to invest in, either through families or through other services that we provide. And that is a great value to the economy overall. And therefore I think it's something that we should all be sort of supporting, and is very useful. And it's worth bearing in mind that the AIM market itself is actually not a stock market, it's a quotation system. It allows people to essentially trade in what, in the eyes of the taxman at least, are private businesses. So if you were to remove it for the AIM, you'd have to notionally remove it for other private businesses as well to be consistent.
Just quick 30 seconds, comment from each of you. Let's forget the inheritance tax benefits for the moment. Why should I invest in AIM, starting with Stephen?
I do feel that tomorrow's winners are going to come from that area of the market. Some of the largest companies to date started as micro caps. Look at Walmart back in the day, or Domino's Pizza started life on AIM before gravitating up there. There are some world-class entrepreneurs on AIM, and it's worth backing them and providing a growth capital to them. It might not necessarily be a core part of the portfolio, but as a addition, it can be a nice diversifier. As Chris was saying, it marches to the beat of a different drum than the main market. There is a lot more structural growth on AIM. They can be more resilient, they're more fleet of foot, they're more nimble, they can re-engineer the business models, etc., etc. There's a lot going for them. Small part of the portfolio for some that aren't the IHT investors. I think it's a sensible strategy.
I agree with that, but I also would add that there's a large number of small cap companies down there that are family-based businesses. They're excellent quality companies. They deliver good returns. They deliver good cash flows, and they're trading on actually very often very low multiples. So it can be about the future and about the long-term growth of the business, but it can just also be about the fact you're buying a good or a fair to good company on a sensible price, or even a cheap price. So it is a stock pickers market, and there is the ideas there down to be had, and you should be able to deliver good investment returns. And then the tax break comes on top.
We've spoken about the size of AIM. There are over 900 companies listed on AIM, and a lot of those would be unsuitable in my mind for inclusion in an IHT portfolio. We run an income and a growth version of our inheritance tax service, and we hold 30 stocks in each, and that represents less than 3% of the quoted companies listed on AIM in each of those portfolios. And I believe very firmly that if you can secure alignment of interest in the way that we've previously discussed, if you're backing proper businesses that are profitable, cash generative, and preferably paying dividends at the point of investment, then there's absolutely no reason over time why that portfolio shouldn't perform at least as well as the main index. And I'd be pretty hopeful of being able to deliver superior performance than the main index.
Chris, Justin and Stephen, thank you very much.